Wow. If you were watching the silver market, you saw it happen. Just a sudden, sharp, really ugly drop in price that seemed to come out of absolutely nowhere. But what if I told you this had nothing to do with supply and it had zero to do with demand? The real reason? Well, it's kind of buried deep in the market's plumbing. And believe me, it's a story we have seen play out before. And that's it. That is the entire key right there. This wasn't about the big long-term story for silver. Nope. This was a purely technical event, a rule change deep down in the financial plumbing that was almost designed to force a very specific and very sudden outcome. So you can just forget all the usual market forces you hear about. This had nothing, and I mean nothing, to do with new mining data or how many solar panels are being built. The trigger was something way more direct and, frankly, way more mechanical. It all came down to a margin hike. See, the exchange, the CME, just suddenly increased the amount of cash that traders needed to have on hand to hold their silver positions. And that one change? It forced this automatic, just brutal wave of selling from anyone, literally anyone, who couldn't cough up more cash on the spot. Now, that term, margin squeeze, I know, it sounds like some super complex Wall Street jargon, but it's actually a surprisingly simple mechanism. So let's just walk through exactly how it works. Because once you get this, you'll understand why these price drops are so incredibly violent.
Okay, so what even is futures margin? The easiest way to think about it is like a performance bond, or maybe even a security deposit. When you're trading silver futures, you get to control a huge amount of metal with a pretty small amount of your own money. The margin is the collateral you have to post to prove you can handle the wild price swings. It's really important to get this. It is not a down payment on the metal. It's basically the exchange looking at you and saying, hey, prove to me you can survive the volatility here.
Okay, so here's how the chain reaction just explodes. Picture this. One moment, you're holding your leveraged position, everything's going great. The very next, bam, the exchange hikes the margin requirement. That instantly triggers a call from your broker, and they're demanding more cash. And not tomorrow, they mean right now. If you can't wire it instantly, there's no talking, no negotiating. Your position just gets liquidated, sold automatically at whatever the current market price is. And that's what creates that first wave of forced selling. And you know, what's really fascinating or maybe frustrating about this whole process is who gets hit. The system doesn't liquidate the traders who are wrong about the market's direction. It liquidates the traders who are the least liquid. Think about it. Big institutions, they've got massive credit lines. They can move millions in minutes. But smaller traders, retail folks like you and me, we often can't do that. So these margin hikes are almost structurally designed to hit the smaller players first and hit them the hardest. And you gotta understand, we're not just talking about a few individual accounts getting closed out here and there. No way. When this happens to thousands of traders all at the same time, their forced selling creates this massive domino effect. It turns what was a small problem into a full-blown, market-wide avalanche. You can literally see how the downward spiral just accelerates. The first margin calls force some selling, which pushes the price down. But then that price drop triggers a whole other wave of automatic selling from stop-loss orders that other traders had in place. So you get more selling, which pushes the price down even further, which triggers even more stops. It just becomes this vicious, self-feeding loop that turns a small dip into an absolute waterfall. And this whole cascade, it happens at the speed of light. I mean, we are talking about algorithms trading an absolutely absurd volume of paper silver. We're talking futures contracts here, in the span of just a few minutes. It's not because tons of physical metal is suddenly being sold. It's because millions of claims on that metal are all being dumped onto the market at the exact same time. And this right here, this brings us to probably the most crucial concept you have to understand to make any sense of this market. There are, for all practical purposes, two different silver markets. You've got the paper market, that's where the screen price gets set, and you've got the physical market, where actual real coins and bars are bought and sold. And the key is they can and often do behave very differently. So let's break that down. The paper market, it's all about futures contracts. It's all about leverage. It's what creates that screen price that we all see on the news. But you have to remember, it's built on a pretty fragile foundation. Now, the physical market, that's a different beast entirely. That's about real coins, real bars being bought by real end users. It's slower, it's steadier, and it is structurally way, way more solid. So here is the key signal. This is what you have to watch. When the paper price is absolutely plummeting, but the premiums you have to pay for a real physical coin or bar, when they don't budge, or maybe they even go up, that is a massive signal. It's the market telling you that the real world, the world of end users, is not panicking.
This wasn't the world suddenly deciding it hates silver. No. This was just leverage getting violently purged from the system. And if you're getting a weird sense of déjà vu right now, well, you should be. This isn't some random, once-in-a-lifetime black swan event. When it comes to silver, this exact mechanism, this is a known playbook. It's been used before, specifically to halt powerful rallies. It's a pattern, and it keeps repeating. I mean, just look back through history. 1980, silver's on that legendary parabolic run. What happens? Rule changes and margin hikes are used to completely break the rally. Okay, let's fast forward to 2011. Silver is getting super close to its all-time high. And what do we see? A quick series of margin hikes that reverses the trend hard. And here we are again, a big surge in price followed by, you guessed it, a margin increase that triggers another sharp liquidation. See the pattern? Now, the official reason you'll always hear is risk management. We're just protecting the market from all this volatility. And look, there's some truth to that. But the practical effect? Well, it's an incredibly powerful tool. It instantly crushes buying power and purges all those leveraged buyers from the market. It's basically a giant brake pedal they can slam on a rally right when it's picking up steam. Now, whether that's a feature of the system or a bug, well, that's a whole other debate, isn't it? All right, so after a day like this, with all the panic and noise, how do you figure out what's real and what's just, well, noise? Let's talk about what really matters from this point forward. First thing, and honestly, this might be the most expensive and important lesson in all of commodities trading. You can be 100% right on the fundamentals, you can have the supply and demand story nailed down perfectly, and still get absolutely destroyed by the mechanics of the market. If you're using leverage, you have to remember, you're not just trading silver, you're trading the rules of the game. So for a minute, just try to ignore the crazy daily price swings. Instead, here are 4 signals that are going to tell you the real story. Number 1, physical premiums. What are people actually paying to get their hands on the metal? Are they going up or down? Number 2, warehouse inventory. Is physical silver draining out of the official vaults, or is it building up? 3, delivery behavior. Are the big traders demanding to take actual physical metal, or are they just rolling their paper contracts? And finally, number 4, global price alignment. Are we seeing prices in, say, London diverge from prices in Shanghai? That's where you're going to find the truth, not on the screen. So let's just wrap this up. What happened today was a violent, yes, but ultimately mechanical purge of leverage. It was a shakeout. It cleared out the unstable positions, the weak hands, as they say. But here's what it didn't do. It didn't magically create more silver in the ground, and it definitely didn't erase the growing demand for it in industry. The underlying fundamental story, that hasn't changed one bit. And so that really just leaves us with one final question to think about, doesn't it? After you've seen exactly how the paper market can be shoved around by simple rule changes, which market do you trust more? The flickering price you see on a screen, the one that's driven by leverage and algorithms, or the real-world price, the one people are actually paying right now to hold a real piece of metal in their hands?